Page 461. So chapter 16, there is precious little from chapter 16 that you need to focus on, basic residential construction. But they do like to give you on page 462 and 463, that vocabulary on those 2 pages is where the potential test questions would come from. I would say for certain, let's talk about footings over there on the left-hand side on page 462. Where are your feet located? The lowest part of your body, right? The same is true for a house. The footers are the lowest part of the construction, and they're actually so low they are where? Underground. The footers are underground because that is where the foundation wall sits on top of. What you see above ground is the foundation wall, and that sits on top of the footers, which are actually dug into the ground. It's actually usually just poured cement. They usually dig trenches and come and pour cement around where the frame of the house is going to be. Now, if you see cement blocks or brick, that's usually the foundation wall itself. That's the part that's actually above the ground in most cases. Okay, so what you see above the ground that's brick or block from the ground up to where the wood in the house starts, that's called the foundation wall. And then the piers. Again, I've said this before, when you think of a fishing pier, what's the first visual image that pops in your head? The upright post, right, that hold it up. Same thing is true for a house. So if you were to look underneath a house, those upright columns that are underneath the floor are called piers. Now, in North Carolina, what's the most common type of foundation? A crawl space. Most common type. What's the least common type? Basement. Basement, by far the least common type. I would say knowing that that's the least common one, yeah. But, you know, when you say, do I need to know that? Well, look around you. How many do you see? There you go. So, I mean, you already know it. My answer to that would be you already know that that's the least common one because you just don't see them very often in North Carolina.
Wait, could you say that pier again?
Underneath the floor. So if you looked under the house, in the crawl, so piers would be in what type of a foundation? Crawl space. A crawl space. You would see piers in a crawl space. Well, they could be finished or not finished, but they're usually going to have posts rather than piers, because posts are smaller than piers. Piers, you don't really care what they look like because they're in a crawl space.
So posts are very long piers?
Piers are going to be much thicker than posts. If you go in a basement, the posts they're usually very small, 4x4, 6x6 at most. Piers are going to be very large brick. That is a post. A pier would be larger than that in most cases. All right, and piers are going to be made out of brick or block, whereas once you're in a basement and you're looking at posts, they're usually either steel posts or wood posts. Okay? Yes?
Coast houses that are on stilts? Are
Coast
those piers?
Coast houses that are on stilts, yeah. They're called stilts.
Oh,
they're just called stilts. There's
okay.
Yep. And yeah. All right, on page 463, I would say the vocabulary on this page to pay attention to, number one, the sill, S-I-L-L. The sill is the lowest piece of wood in the entire house. Think of the footers are made of what? Concrete, poured in the ground. Foundation wall is made of what? Some type of masonry, brick, block, some kind of masonry, right? At some point, the house is built out of what primarily? Wood. We have to transition at some point from all this concrete and brick and block to wood. And where that transition happens, the first piece of wood that lays on top of the foundation wall is called the sill. That is the sill. Um, floor joists. You don't need to know what the intervals are. You don't need to know anything. Those are just the support pieces of the floor structure. Everybody knows what studs are in a wall, right? You know the studs are the pieces that hold the wall up. Well, floor joists are the studs of the floor. It's the support for the floor. So what would the floor joists sit on top of, do you think? They would sit on top of the piers in the middle of, out in the middle of the floor, but on the outside edge, what would they sit on top of? The sill. The sill sits on top of the foundation wall, and then the floor joists sit on top of the sill. And then the piers are evenly spaced in the middle so that the floor doesn't sag from side to side. Because imagine if you got houses sometimes they're 60 feet wide. Imagine a floor joist going all the way across there. It would bend and bow. You could never have a piece of wood that's that strong. So you have piers in the middle to help support it. Is everybody okay on that? I would say also know what headers are, which is in that middle paragraph there. Headers are the pieces of wood that give support above a hole in the wall. So what are your big examples of holes in the wall? Doors and windows. Windows and doors. So everywhere you have, think of it this way. When you have this door right here, there's a tremendous amount of weight sitting above that door. You got a whole building up there, another floor, you got the roof. All that weight is sitting up there. That weight is pressing down, correct? Well, normally the wall is providing structure to hold that weight up. But when you have a cutout in the wall, that gap right there, there's nothing supporting that weight right there. So a header is just a solid piece of wood that goes from one side to the other and transfers the weight so that this doesn't sag. Otherwise, all your doors would stick and your windows would break in your house because they would sag over time. So a header is just above windows and doors.
I never thought about it that way.
That's what it's there for.
Hole in a wall, and where does all of that weight go?
It gets transferred from one side to the other. So just imagine you've got a piece of wood on either side of the door with a big piece of wood sitting on top of it, and that transfers the weight.
So when somebody wants to knock on a wall that's load bearing, they would put this in place.
They would put a header in place. That's exactly right. If you take out a load-bearing wall, you're going to have to put some sort of a header to take that weight. Okay, everybody good? I would say the only other things to pay attention to are down there at the bottom of the page. The ridge board. The ridge board is sort of the opposite of the sill. The sill is the lowest piece of wood. What is the ridge board? The highest piece of wood. So I'm a terrible artist, but when you have your roof line coming together, you have your rafters that meet in the middle right there. And right there in the middle where they meet, there's a piece of wood that both of them attach to. That's the ridge board. So the very high, that's at the very peak of the house. And then down at the bottom, they mention the eave, the fascia, the soffit, and the frieze. All you need to know is all those are part of the overhang of the roof. So, roofs don't stop at the wall. They generally have an overhang. If you look up, if you stand in front of a house and look up, there's almost always an overhang of at least a foot where the roof comes out past the edge of the house so that the water doesn't just wash right down the side of the house. That's all those are components of that overhang. And that is it for chapter 16. Is called the eave, right? And all those other things are just parts of the eave. The fascia, the soffit, the frieze board, all those are different parts of the eave.
What would a question be worded like this?
It's going to be it's going to be a definition. It would say like the soffit, the fascia, and the frieze board are all components of which of the following, and eave would be one. Yeah, eave would be one of the choices. It's going to be that straightforward. Literally. The couple of questions you see from this chapter are, do you know these definitions? If you know the definitions, they're slam dunk questions. If you don't know them, you're just guessing. Okay. You don't need to know the different types of roofs. Nope. You might need to know what roof pitch is. Roof pitch is just the slope. That's the slope of the roof.
So it would be like mutants and windows.
Munions and mittens, mutants. Is that what he asked me about mutants. No. In Windows, I have seen in the past they've asked about, or I've had students say they would ask about the tic-tac-toe boards in the windows. You know, the cross panes in the tic-tac-toe boards. You know, the hashtag signs for my millennials in the room, and in the window. Well, traditionally they did not pop out. Traditionally, those were actually individual pieces of glass. You know, that's the way the windows were constructed. Now, most of the time, they just snap in. But they are called Mintons and mullions. So if you see two weird M words, they're window parts of the window. That's all you need to know. Just think of M as an upside down W. So weird M words, that's a window part.
Would they literally ask what the two?
No mutants in your windows, but Mintons and mullions are okay.
Would they literally ask the tic-tac-toe?
No, they would say Mintons and mullions are components of which of the following, and the answer would be windows. I'm telling you, they don't get any more straightforward than the kinds of questions you get on basic residential construction. They're not asking for any thought on that stuff.
We don't know the different types of houses, Victorian.
Nope, absolutely not. That's it for chapter 16.
Not installation.
Okay. I said it's it. At the end of the chapter, page 469, just make sure you know the difference between a certificate of occupancy and a building permit. A building permit is permission to construct, to build. And a certificate of occupancy is proof that you've complied with the building codes, proof that you've followed that process.
But not moving.
One more time.
A certificate of occupancy?
Well, the first one.
A building permit?
Building
A building permit is permission to improve, and a certificate of occupancy is proof that you followed that process. So you can't get a CO without first getting a what? A building permit. And then you build it, and then they come, inspect it, and if it passes the inspection, they give you a certificate of occupancy.
So when we're looking at a listing on MLS, it lists the building permits, but I've never seen it list the certificates of occupancy. Is that ensued?
Well, the way they generally refer to it when you're checking something like that is, has the permit been closed? They'll say that the permit's been closed if a CO's been issued for it.
So if you only see a building permit,
If you see an open building permit, that means they never got their certificate of occupancy. Okay? That's it for 16. Nope.
You must get a license if it's more than $30,000.
Not to my knowledge. But if it is, what is it?
More than
What is it?
$30,000.
You do?
You need to, whatever the cost
And what's the number?
permit, $30,000.
$30,000. If you do more than $30,000 in work, you need a general contractor's license.
Do we need to know about their vacation and all that stuff there?
that's not on the test.
What vacation?
Not vacation, you know how they, are they W-2s or contractors?
No. No. All right, chapter 17. Now, chapter 17, we've pretty much covered with the math. I mean, obviously, the vast majority of questions that come from chapter 17 are going to be math-based questions. You're going to have several CMA-based questions. You're going to have a cost approach to value question. You're going to have an income capitalization. You can't pass this test without the math. If you think you can, you are fooling yourself. You have to get the math. If you don't have it yet, you got all weekend to work on it because you cannot pass it without it. I just had this discussion with a student last night from the night class. She called me so frustrated. She said, well, I just can't get the math, so I have to get everything else. I said, that is the wrong approach because you'll never pass it that way. You can't do it without the math. And especially this chapter, you cannot do it without the math because that's the vast majority of this chapter. there are a few potential other questions that you might see. When we talk about valuation, we talk about appraisals. We talk about appraisals and we talk about our opinions of value. What's the difference between an appraisal and a real estate broker's opinion of value?
Licensed appraiser.
Done by a licensed appraiser, but they're both opinions of value, by the way. One's formal, the which one? The appraisal, and ours is informal. Good. The formal one is done by a licensed appraiser. Now, how long is an appraisal or any opinion of value valid for? That one day that it's done. It's an opinion of value based on some established system for that day. And when we say some established system, it's going to be dictated by the type of property, right? Because if it's a residential property, what system are we going to use to come up with the value for it? The sales comparison approach to value. That's what we use to value residential property. If it's an income producing property, we're going to use what system to come up with a value for it? The income capitalization approach. And if it's a special use property, we're going to use which one? The cost approach. Good. Make sure
Can you list those one more time? Sorry.
Yeah.
Residential.
the sales comparison approach.
That's just like a CMA, right?
That is the CMA. The CMA is the sales comparison approach. So what is the sales comparison approach? When I am comparing my subject property to what? What is a comp, though?
That is another property that's similar, that's been sold already.
There's the word I was looking for. Recently sold similar properties. That is the sales comparison approach. I am comparing my subject property to other similar recently sold properties in order to come up with a value for it. It's based on this economic principle of substitution. What is the principle of substitution? That given a choice between two fairly similar things, people will do what? Choose the cheaper one. That is the principle of substitution, and it is the basis for the sales comparison approach.
What did you say special use was called?
The cost approach.
And the income capitalization approach is
Income producing.
Special use.
oh yeah, income.
Income producing. We don't care what it looks like. We care what it does.
That's the one where we have depreciation.
I'm sorry?
Yeah.
Income capitalization approach. The cost approach is the one that takes into account depreciation. Okay. Over on page 476, 477, we just talked about the principle of substitution. What about the principle of conformity? You get the best return on your investment when your property is what? Similar to its surroundings. Good. 477, 476, 77.
What's the idea called? I'm sorry, I didn't hear what y'all just said.
What now? The principle of conformity. Over on page 483, let's talk about the sales comparison approach a little bit more and choosing comparable properties. How do you choose good comps? What are you looking for? What's the first word that matters? Similar that have recently sold. Okay, similar that have recently sold. The more recent the better, the more similar the better. Are there any hard rules about it can't be more than this many square feet or it has to be within? No. Whatever is most similar and most recent. We also want to look at the terms of the sale or the conditions of the sale. What does that mean we're looking for? Make sure it's not what kind of things? Make sure it's not a foreclosure, short sale. What else? Make sure it's not a special circumstance, right? We want to make sure it's an arm's length transaction, that it isn't a sale to a relative or something like that.
What did you call it?
Special circumstances, yeah. That's not a vocabulary word. That's just worded verbiage. Yeah.
Say it in my head if I know.
Okay. Now, when we do the sales comparison approach, remember that we are making adjustments, right? That's the whole idea. We compare the subject, that's where we use our hands, right? With the subjects here, and the comp is either superior to or inferior, right? Don't let those words trip you out. It's the same thing that you've always been working with, right? If they say the comp is superior to the subject, which way are you adjusting? Down. You know, if the comp is inferior to the subject, you are adjusting up. And remember, always restate it as the comp is. If they give it to you, if they say the subject is superior to the comp, flip that around. That's the comp is inferior to the subject, because your subject's always in the middle. It can't be superior or inferior. It has to, you got to start and adjust to it, okay? So make sure you're good with that. And obviously the math of a CMA, we've done several of those. Over on page 486, 487, we get into the cost approach. And when we do the cost approach, we are most likely, in fact, always with the math in this class, going to be working with a replacement cost. Remember, you could do replacement cost or reproduction cost. Reproduction just means reproducing the structure exactly as it was. We generally would only do that with what kind of structures? Historic ones, right? Because we don't want to build it with a new type structure. We want to reproduce it exactly as it was. That's much more expensive, which is why we don't do it very often. Most of the time, we simply look at a replacement cost. And when we look at a replacement cost, we look at just the square foot method. Dollar per square foot. That's what you're going to be asked to do in an exam setting. Can you do the square foot method when it comes to a cost approach to value? So what are the 3 steps to the cost approach? What do you start with when you're doing a cost approach? Land value. And to that we add what? The replacement cost of the structure, and that's just going to be dollar per square foot times the number of square feet, right? And then what's step 3? Subtract the depreciation, but of the what? Just of the structure. Do not add the land value to it first and then do your depreciation. The depreciation is only on the structure. Land does not depreciate. Okay? Is everybody good with that? No, you're not good with that?
No, no, you kind of lost me there. So the step 1 is the land value.
Land value.
Step 2, separate the land from improvements.
Step 2 is replacement cost.
Of the actual.
Stop looking in the book.
Okay.
That's the most useless document you got in front of you, that book over there.
You got ahead of me.
For
so I was
something,
catching
yeah,
up.
right. No, but for stuff like this, the book is completely useless.
Okay.
All right?
Step 2 is
So-
replacement cost.
That's
of
right.
The building only.
That's right. And so that's just going to be dollars per square foot times the number of square feet.
Okay.
And then step 3 is to subtract the depreciation, and again, only of the structure. Don't add the land value to it and then do the depreciation.
Okay.
You only want to depreciate the structure.
Okay.
And does everybody remember how to do the math of the depreciation, right? You're going to take 100 and divide that by the economic life, however many years it says it's going to last, and then that gives you your annual depreciation. Get that amount and then multiply that times the number of years that it's depreciated. Everybody good on that? Okay?
And then what was the 4th step?
There is no 4th step. That's it.
100 divided by the economic life.
100 divided by the economic life, that's your annual depreciation rate. So the economic life is how long we expect it to be economically useful, right? So if we expect it to be economically useful for 50 years, what's your annual depreciation rate going to be? 2% per year. So you would multiply whatever the replacement cost of that building is times 2%. That's your annual depreciation. And then you would just multiply that times the age of the building, because that's how many years it's depreciated.
Effective age.
Effective age. That's exactly right. Okay? Is everybody good on that? Now, let's follow up a little bit more on that depreciation. Turn over on page 488. There are different types. Now, it doesn't matter for the math, but from a theory perspective, there are different types of depreciation. There's deterioration and there's obsolescence. Okay? Deterioration means something is what? Breaking down, physically falling apart. It's either broken, on the way to breaking down, but it's in less than good condition. Okay? That is deterioration. What is obsolescence?
It's no longer.
It still works, it still functions as it was intended, but it's not what today's users want, right? It,
5 bedrooms and 1 bath.
5 bedrooms, 1 bathroom would be an example of a functional obsolescence, right?
Like a pump water thing outside.
That would be a functional obsolescence. A hand pump for water would certainly be a functional obsolescence. You know, an outhouse would be a functional obsolescence. It still performs the function that it was intended for, correct? You know? But no buyer wants that. Does that make sense? Now, can that be fixed? Yes. Okay, so functional obsolescences can be fixed. There's also one called an economic obsolescence. An economic obsolescence cannot be fixed. It is something that buyers don't want, but the problem is it's not on our property, it just impacts our property. So an example of an economic obsolescence would be like a dump next door, a trailer park beside our house, the airport if you live in Briar Creek. Those are economic obsolescences. Do they reduce the value of the surrounding properties? Absolutely. Is there anything that those property owners can do about it? No, because it's not under their control. So that's the difference between a functional obsolescence and an economic obsolescence. A functional obsolescence is something on my property. It's in my control. I could do something about it if I wanted to. Does that make sense for everybody? Whereas an economic, I can't.
So physical deterioration is just that it's not working anymore.
Right, it's breaking. So a leaky roof. The roof has deteriorated and it's leaking. That's a physical deterioration. You know. Well, the question of curable or incurable doesn't relate to whether we can do it or not. It relates to whether it makes economic sense to do it. So we say something is curable if it's cost effective. It's incurable if it's not cost effective.
Like a leaky roof.
A leaky roof would most likely be a curable physical deterioration. The roof blew off and we got 26 inches of rain after that would probably be an incurable physical deterioration. That's not nearly as important as understanding the difference between deterioration, obsolescence, and then understanding the difference between a functional obsolescence and an economic obsolescence. Okay, we good on those? All right, and then finally we have the income capitalization approach, which would be used anytime we have an income producing property. So the way to think of the income capitalization approach is that it's a way that we come up with a value for the property based on the income we expect it to produce in the future. We're looking, and what do we base its future income on, potential? On its historical or past income. If I'm looking at a property and saying, I think it's going to produce this income, I'm mostly basing that on what it's produced in the past, right? So the income capitalization approach is just basically taking the potential future income and converting it into a value.
And they disclose that previous.
Yeah, if you're marketing the property, you're going to have your books open so people can see what the income is. Is everybody okay on that? Are you good on the math of that? What is that formula for the income capitalization approach? So what if I wanted the value, it's what? How do I calculate the value? NOI divided by the cap rate. Net operating income divided by the capitalization rate. If you don't have that formula instantly, you should, go back and look at it because you're going to have it. Equals what? Then write it in. Don't leave it blank. They will give you the capitalization rate in a math question. They would. In a math question, they will give you the capitalization rate. I'm sorry? They'd probably make you figure out the NOI. Yeah.
You just figure out the NOI by doing the gross,
Gross potential minus vacancies, which is gross effective, minus operating expenses is NOI. Mm-hmm. Yeah, so for return on investment, you just take it all the way down to before tax cash flow. Everybody good on that? The income capitalization approach? Good. I think that is it for chapter 17. No, I said if you asked would you use that formula for return on investment. I said if you were looking at return on investment, you would take it down to before tax cash flow. Return on investment is going to be before tax cash flow divided by investment. But investment's not value. It's not the same thing because investment is how much you invested. All right. Chapter 18. This one takes a long time to go through. What's a capital gain? How much you made when you do what? When you sell the property. No, it doesn't. Capital gain doesn't have anything to do with a primary residence. We're talking about whether you're exempt from capital gains taxes. But what is a capital gain? A capital gain is simply the difference between what you invested in a property and what you sold it for. What are those words called? What do we name? What are the fancy words there? The what? The adjusted basis and the amount realized. You need to know those terminologies. So the amount realized minus the adjusted basis equals the capital gain. Yes, ma'am.
So the amount realized is what sold.
What you sold it for minus any costs for selling it, like commissions and all those kinds of things. That's right.
Capital gain is just what you get once you sell a property.
That's right. What you made, what you profited. Your profit is your capital gain. Now, the problem with a gain is it's taxable, right? Okay? So, we pay capital gains taxes anytime we sell a property. If we have owned it for less than a year, what kind of capital gain is that?
All we pay taxes on.
Short-term capital gain. If we have owned the property for less than a year, that is a short-term capital gain. If we've owned it for more than a year, that is a long-term capital gain. Why is that an important distinction? The tax rate is much what?
Higher.
Much higher for a short-term capital gain. Long-term capital gains get taxed at a much lower rate. What is that rate? 15%. That's right.
For the short term, 36.
It's whatever your income tax bracket is. Because it's just income.
That's less than a year?
That's for short term, right. Long term is 15%. Do we pay capital gains taxes on all capital gains? No. How many things are exempt?
If you lived in the resident for 2 years or more, and then
That's five.
So how many things are exempt? One. What is that exemption? For what kind? You're talking about the amount. You haven't told me one time yet what the exemption is.
Personal house.
My primary residence. That's exactly right. I know you're getting there, but you got to tell me what the exemption's for. The only type of property I don't pay a capital gains tax on is my what?
primary residence.
Primary residence. And I may still pay one on that, but I get a big free range there. If it's my what? Primary residence. So what makes it my primary residence? Previous 2 out of the previous 5, I've lived there. Okay, good. So if I've lived there 2 out of the previous 5 years, I'm selling it as my primary residence. How much capital gain is tax-free for me if I'm single? $250,000. So if I have a capital gain of $275,000, how much am I going to pay taxes on? 25. Do I pay 25,000 in taxes, or is that the amount that's taxed? That's the amount that's taxed. I would multiply that times 15%. Good. Good. If I'm married, what's that exemption? $500,000. 500,000. Has everybody got that? Good. If you have a house, you should get a wife, he said.
Only if you wanna live there for more than 2 years, you can't make money on it.
And you wanna split it if you're trying to roll. I'm just saying.
Okay.
We
Or
would
just
take.
stay single and move a lot.
That's it.
Make sure you know all the things that go into an amount realized and an adjusted basis. You know, so in an adjusted basis, what things count toward the adjusted basis?
Any of the improvements.
Improvements. How about the purchase price? Don't forget that. The original purchase price, right? What else? And closing costs. What doesn't count toward it? Maintenance and redecorating. And I heard Fred say it. Loans. We don't care about loans when it comes to capital gains. Okay?
Or you don't care about discount points.
That's a loan. Right, that's a loan expense.
Wait, what were they? Improvements, original purchase price,
Yeah.
and
You tell me. Closing costs.
closing costs. Okay.
So capital gain is pretty much like the money that you would take away after you sold a house minus like
Bingo.
In
That's
order to
exactly
be
what
able
it
to
is.
do those math questions without checking the book, you have to know all this stuff. So I
Mm-hmm.
went back and redid them.
Yeah.
but the taxing for it is kind of what gets me. So basically if I got a capital gain after selling my house of just like $2,000, you're saying I would have to tax off that?
No.
No.
Because how much capital gain are you allowed to have on your house, on your primary residence, without paying any tax at all?
Oh, that's where the two.
That's where the 250 comes in. So when you figure your capital gain, your tax is zero unless that gain exceeds how much money?
Okay.
$250,000 if you're single, or $500 if you're married. Okay? So you zero all the way up to that point. And then you just pay 15% on every dollar above that point.
Gotcha.
So it's 15%, because in the book I see 20.
Yeah, it's 15. You won't be tested on that. No.
Is it state-based or is it?
No, it's federal.
Federal?
It can go up to 20, but it's only 20 for people in the absolute highest tax bracket. So for the vast majority of us, it's 15.
Okay. So on test question, it's gonna be 15 if they ask.
They'll tell you the rate to use, but they'll say 15.
Okay.
Okay?
The adjusted basis closing costs are for the new sale?
Which would it be?
No,
The adjusted basis is when you did what?
when you bought the house.
When you bought it. So what closing costs is it going to be? When you bought it. What are you going to do with closing costs when you sold it?
That goes in the amount realized.
There you go. There you go. Okay? Good on that? That's it for the taxation chapter. That is it. Well, I will mention this. If I wanted to defer paying capital gains tax, what would I do?
Reinvest.
A 1031.
A 1031 exchange. I would reinvest the sale. Yep.
Wait, what was that? Can you read?
I do a 1031 exchange, a 1031 tax deferred exchange, if I wanted to defer paying those taxes.
And on the test, it would be called that, it wouldn't be called reinvest. right?
It would just be called a tax deferred exchange or a 1031 exchange.
And that's where you use that money to buy other real estate.
That's right. You have to reinvest the money. You have to reinvest it.
You can't touch it.
You cannot touch it. You have to roll it over
and then they don't tax it.
until later, until you touch the money. You don't pay the tax until you touch the money.
How do you make money the whole time? Is it?
Income. Income. The properties are income. Remember, these are income producing properties. because you would not be worried about a capital gains tax on your residence, right? Because you got the exemption for your residence. So
So even if you're getting out a house, that's the same thing.
that's an income producing property.
Cool.
That's right.
So 1031 is basically another exemption in a way.
It is. Well, it's a way to avoid paying the tax for, an unknown period of time, and maybe forever if you die. Okay, that's it for chapter 18. Knocking them down. Chapter 19, fair housing. So, in this chapter, obviously one thing you must know are the 7 protected classes when it comes to federal fair housing law and North Carolina fair housing law for that matter, because they're the same 7. What are the 7 protected classes? Fresh corn with no vowels, right? Fresh corn, right? Right. Exactly. So, what are they? Race, color, religion, national origin, sex, familial status, handicapping status, right?
Hold on. I know that. What was the F?
Familial status.
That's it. What's the X? Race.
Sex.
And then ages.
What?
What's age?
Handicapping status. Everybody? National origin. Familial status, race, sex, handicap, color, religion, national origin. Where's age in that list?
It's not there.
Is it on that list?
That's why we have old communities money.
It's not on that list. Are you surprised it's not on that list? You're not surprised?
That's for the credit, right?
Yeah, but my point is that kind of one that most people would be a little bit surprised is not a protected class?
Yeah.
So is that one that's fair game for a test?
Yeah.
Are they going to try to throw age in there as a protected class on a test? Especially since age is a protected class under another federal law. Which federal law is that? The Equal Credit Opportunity Act. So I would highly suggest you recognize the differences in the protected classes between the Fair Housing Law and the Equal Credit Opportunity Act, because 5 of them are the same, but 2 of them are different. What 2 go away in the Equal Credit Opportunity Act? Familial status and handicapping status. And what are they replaced with? Age and marital status. So is marital status a protected class in the fair housing statutes? No. Is marital status a protected class in the fair housing statute? No. Is age a protected class in fair housing? No. Travis refuses to rent rooms to people over the age of 45. This is a violation of which of the following? Number 1, the Federal Fair Housing Act. Number 2, the Equal Credit Opportunity Act. The answers are 1 only, 2 only, neither 1 nor 2, both 1 and 2. Neither. Neither, because it has nothing to do with financing. Travis refuses to rent a room to someone over the age of 45. It's not a violation of the Fair Housing Act because age is not a protected class. It's not a violation of the Equal Credit Opportunity Act because when is the Equal Credit Opportunity Act in effect? When we're doing what? When we're making loans. It's a violation of neither. Pay attention to those. Okay? Pay very special attention to those questions.
But they both have 7 classes.
They both have 7 protected, and the first 5 are the same in both. Race, color, religion, national origin, sex are the same in both. Okay? Everybody good on that?
I have a quick question. What's the difference between familial and marital?
What is the difference between familial? That was actually my next point. What is familial status? Children.
Okay.
So what's the difference between children and marriage? They're just not the same thing, right? Yeah. I mean, does familial status have anything to do with whether I'm married? No, not at all, because it only refers to children. Does marital status have anything to do with kids? No, because it only refers to marriage. All right? They're just 2 separate things. Is everybody good with that?
You could discriminate between marriage and the federal fair housing.
Under fair housing, but not under what?
Not under the
Equal credit opportunity. So it is entirely legal to say I will not rent to a single person. That's a legal statement, is it not? I will not rent this house to a single person.
Oh, well, yeah.
That's a legal statement. I mean, what would be wrong with it? Because what law would be in effect when I'm saying I will not rent? What law is there to protect against that? Fair housing. And marital status is not a protected class under fair housing, correct? How about I won't make loans to somebody who's single? Is that a violation of the law? Which law? The Equal Credit Opportunity Act. Okay, is everybody good on that? Okay. Also, when it comes to fair housing, make sure you understand you also can't have like covenants that violate fair housing law. You know, you can't have restrictive covenants. Or, you know, we talk about like what happens when covenants conflict with zoning and all that sort of thing. Well, you follow the most restrictive, but you can't follow one that violates something like the fair housing law. You can't have a covenant that says, no Jewish people are allowed to live in this neighborhood. You just can't do that. You can't.
They have no children.
I'm sorry? They can't have covenants that say no children unless it is a specific 55 and up neighborhood that's exempt from which part of the fair housing law? Familial status. That's a special exception.
And that's where they go and get a variance to the zoning, or do they
No.
get permission?
They have to get permission from the federal government, actually, in order to be an exemption. Okay? Make sure you know the exemptions to the fair housing laws. There are different exemptions to the federal act and the state act. Does everybody remember that? There are certain times, what I mean when it's exempt, we don't have to follow fair housing. There are certain transactions where we don't have to follow the fair housing laws. What are they? FSBOs. FSBOs do not have to follow the Fair Housing Act as long as they don't involve who? A real estate broker, and they don't advertise that they're discriminating. They can discriminate, correct?
Except for race.
I'm sorry?
Except for race.
Except for race, and why is that?
There's another law.
It's the old one, 18 something something.
The Civil Rights Act of 1866 says you cannot discriminate on the basis of race, and how many exemptions are there to that act? None. So you may never discriminate on the basis of race. Good point. What other exemptions are there to the Federal Fair Housing Act other than a FSBO? Think about rentals.
If you own less than 3 or something like that,
And you're doing what?
you're living there too.
You live in the property and you are,
Not a realtor.
you're not a realtor, okay, and you're doing what?
You're renting it out.
Yes. If I live there and I'm renting out part of the property and I don't involve a broker, can I discriminate? Yes. That's another exemption. So the 2 big exemptions we talk about are FSBOs, right?
This is for federal, right?
For the Federal Act. Yep, we haven't gotten there yet. For the Federal Act, the 2 big exemptions are FSBOs and if I live in the property and I'm going to rent out part of it. In other words, if I'm going to have to live with the people I'm renting to, then I get to choose. And if I want to be discriminatory in that choosing, I can. Does everybody You don't need to know all that. That's too deep into the woods. Is everybody good? Now, there's a State Fair Housing Act. The protected classes are exactly the same. What's different about the State Act from the Federal Act? The exemptions are different. The exemptions are different.
So there's the, so that would be the SFHA, the State Fair Housing Act?
I've never heard it referred to as an acronym of SFHA, but if that makes you feel better, then by all means, yes. The North Carolina Fair Housing Act. So the classes are the same: race, color, religion, national origin, sex, familial status, handicapping status. Same protected classes in the State Fair Housing Act. Same rule applies about brokers. If a broker's involved, there are no what? No exemptions. But if a broker's not involved, how do the exemptions differ with the State Act?
They have that same-sex dormitory thing.
Okay, we could have same-sex dormitories, and that's okay. FSBOs are exempt in the Federal Act, but are not exempt in the State Act. So, a FSBO selling their own house, can they discriminate? No, that would be in violation of which law?
The North Carolina.
The North Carolina Fair Housing Act, but not a violation of the Federal Fair Housing Act.
So in North Carolina, for sale by owners, can't.
Cannot discriminate. That is correct.
Another state.
That is correct.
And you have to follow both of them.
You're right. That's right.
So, like,
Now, what about the state exemption as far as renting property goes? We just talked about selling. Let's talk about renting. In the Federal Act, if I live there, I can discriminate. What is it in the State Act? If me or a family member lives there, then I can discriminate in who I rent to.
Oh, in the federal, it's just it only if you.
Only if I live there. And when are we exempt from the Civil Rights Act of 1866? Never. Never. So that means no matter what the situation is, you can never discriminate on the basis of race.
Could you repeat that question you mentioned a few minutes ago about I cannot rent to somebody over the age of 45? What was that question?
Travis refuses to rent property to persons over the age of 45. This is a violation of which of the following acts? Number one, the Federal Fair Housing Act. Is that a violation of the Federal Fair Housing Act? No. Why not? Because age is not a protected class. Number two, the Equal Credit Opportunity Act. Is that statement a violation of the Equal Credit Opportunity Act?
it's regarding renting.
That's right, because it's not regarding a loan. It is a protected class under the Equal Credit Opportunity Act, but it's not a loan.
Only when it pertains to the law.
Yeah. Okay? Good on that? And that's a tricky one. But that's the kind of stuff you got to pay attention to. That's what they're going to ask you about on these fair housing questions. It's going to be the differences between the exemptions, or are you paying attention to? Are we talking about credit, or are we talking about housing? That's where the questions are going to come from. I don't either. I don't like it either. I know. I get it. It's frustrating for me too. But that's why I hammer on these differences, because that's where the questions are going to come from.
When we see it, we're gonna hear you yelling in our.
Hopefully, that's always my hope. You see me banging on something or screaming. Exactly. That's right. Right. Okay, page 525, just kind of wrapping up this idea of fair housing. So fair housing violations have different names depending on whether you're dealing with the buyer or the seller. And remember, I said BS is what to remember here, right? Just group them up, BS. Blockbusting is a violation when you're dealing with which party? The seller, BS, right? Blockbusting is a violation when you're dealing with the seller. So any fair housing violation that involves a seller is called blockbusting. Any fair housing violation involving the buyer is called steering. If you are dealing with a buyer and you do something wrong as far as fair housing goes, that's steering. If you're dealing with a seller and you do something wrong as far as fair housing, that's called block busting.
And this is just for the broker.
From the broker's perspective, that's right. That is it for chapter 19. Yes, ma'am.
Can you discriminate against giving somebody a loan if they have a kid?
Can you discriminate against somebody giving them a loan on the basis of them having a child? What is the answer to that question?
Yes.
Yes. Her question is, can you legally discriminate on the basis of giving a loan? And can you say to a borrower, I'm not giving you this loan because you have too many children? What is the answer to that question? Yes, because familial status is not a protected class under the Equal Credit Opportunity Act. Can you say, I will not rent you this house because you have too many children? No, because that would be a violation of the Federal Fair Housing Act.
But you could limit the number of people, you just can't specify their children.
Correct. You can have maximum occupancy standards.
Would you mind going through the equal credit opportunity,
Protected classes?
yes.
It's the same ones. What are the first 5? What are the 5 that are consistent?
Well, not familial status.
Okay, so mark that one off the list.
Race is definitely.
Yeah,
So, race and then sex.
yeah.
Okay. Handicap?
Nope. That's the other one that's eliminated.
Okay.
So familial status and handicap go away. So what are you left with?
So then color, religion,
Yep.
and national origin.
Race, color, religion, national origin, and sex. Race, color, religion, national origin, sex. Race, color, religion, national origin, sex. Race, color, religion, national origin, sex. Those are the... I say it so often that it's just imprinted on my brain, right?
I'm just like, they all sound the same.
Right. Race, color, religion, national origin, sex. Those are the 5 that are the same in both. But I wouldn't focus on those 5. I'd focus on the 2 that go away. What are the 2 that go away?
Their handicapping and familial status.
And what they get replaced with?
Age.
Age and
The marriage.
marital status. That's right.
So they both have 7.
They both have 7. And the first 5 are the same.
Okay, awesome.
Okay? That's it for chapter 19. Chapter 20 sincerely might be the easiest chapter to review in the entire class.
Why they have to wait till the end?
Asbestos.
You need to know asbestos. You need to know radon. You need to know lead-based paint. I'm going to discuss all 3 of those because those are the only 3 things that we need to talk about in this chapter. How do you get rid of all 3? That's what we're going to talk about because that's really what the deal is. Knowing what the 3 are, knowing how to get rid of them. So let's talk about the first one, which is asbestos. Asbestos is a material that when it breaks down, and what's the word for when it breaks down? Well, it is friable. Friable means it is breaking down into little airborne particles. It crumbles, it breaks down, and it becomes airborne. That's called friable.
How do you spell that?
Friable. Friable. Okay? Friable. Spell it with a Y. I don't care. I promise it won't make you miss the question.
That's the only thing I remember from when Joe spoke is we get rid of it to baby powder.
Right. Yeah, well, it is like baby powder, okay? It becomes airborne. And that's when it's dangerous. That's when it's dangerous because you can inhale it. And it creates inflammation that can lead to what? Lung cancer. So, how many ways are there to treat it? 2. How many ways are there to treat it? 2. So if you saw on a test, the only way, it would be what? Wrong. There's how many ways to treat it? 2. And what are they?
You can encapsulate it.
You can encapsulate it, which just means you seal it up, right? You seal it up.
That be covering it?
Yeah, covering it up with some kind, permanently covering it, sealing it off, you know. So like, for example, if you had asbestos insulation on a pipe, you could come back with some kind of a vinyl sleeve and seal around the pipe. Seal it up.
It wouldn't be on the wall.
Generally speaking, it wouldn't.
Lead-based paint.
No, you're thinking of lead-based paint.
I'm sorry.
Yeah, well, lead-based paint, you treat it by encapsulating it too. How do you encapsulate lead-based paint? You paint over it. You paint over it. But with asbestos, it would be like insulation or flooring. You could have asbestos-based tile. What would you do? Put some kind of a liner over it that seals it up, and then cover it up. That's encapsulation. What's the other way to treat asbestos? Removal. So removal or encapsulation. Those are the 2 ways you treat it. Okay? Radon. What color is it? Colorless. What does it smell like? Nothing. It's odorless. Right? Colorless, odorless. What does it taste like? Nothing. Tasteless. Colorless, odorless, tasteless. Celery. No, I'm just kidding. All right. Colorless, odorless, tasteless gas. That causes what?
Death.
Lung cancer and eventually death, right? Okay. How do we treat radon? A radon mitigation system, which is essentially a big what?
Pipe.
A fan. It's a fan. It just moves air. That's all it does.
Isn't it like a pipe hooking out of the house?
Yeah, so what it does is it sucks air from your crawl space and vents it above the roof line. So it's a pipe that goes from the crawl space up to above the roof line and it has a fan in it. It just sucks the air and moves it. That's it.
Say the thing is called
Mitigation. You mitigate a problem. Radon mitigation. That's only if you have a high concentration of radon. And what do we define as a high concentration of radon? 4 picocuries. 4 picocuries. I don't know what a picocurie is. It's a tiny little thing.
It's a Pokemon.
Yeah, it is, right. It's some concentration of molecules in air.
Sounds like a Pokemon to me.
Isn't it true that
I think it's named for Marie Curie, by the way. I think it's what it comes.
basements, which is pretty obvious, aren't there just some geographical locations that are more susceptible?
Yes,
to
very
radon?
much so. The mountains. The mountains are much more susceptible to radon. You see almost none of it in the coastal plain, and you see almost all properties have problems with it in the mountains.
We have a lot of it in our neighborhood.
It's not always been a problem. It's becoming increasingly more of a problem as homes become more energy efficient and more sealed up. Homes that are very drafty or have the windows open, you could be on exposed rock and not have a radon problem because the air is changing over. The problem we have now is we're recycling the same air all the time in these properties and they're sealed up, so it just the concentration gets higher and higher and higher.
The radon comes from like a mineral in a rock, right?
Uranium, specifically uranium. And there is a big uranium ore concentrate right underneath Capitol Boulevard, by the way. So homes in and around Capitol Boulevard tend to have high radon readings. It is. I mean, radon itself is not radioactive, but that's the reason that it causes lung cancer is because it emanates from a radioactive material.
It caused lung
And you
cancer
said,
or
was it 4 or 4 point something?
4.0. 4.0. Picocuries. Pokemons. I'm sorry. Yes, I have.
Because I worked at a restaurant right on top of it, and the mountain's all yellow because of certain minerals, and I can't remember what it is. I wonder if
Uranium, it could be. Who knows? Yeah. All right. So everybody good on? So far we've covered asbestos and radon. That leaves us with what? Lead-based paint. What is the magic year for lead-based paint? 1978. You should all remember that year because that is my birth year. So it is a special year for a lot of reasons.
Oh, you're so young.
1978. That's why I am as special as I am, because I came in just in time to eat some lead-based paint, I think. So that is the year that lead-based paint was made illegal in residential properties. Okay, so if the property is built prior to 1978, it has the potential for lead-based paint. And that's all you have to warn a potential buyer or tenant. You don't have to tell them, yes, it does have lead-based paint, or no, it doesn't have lead-based paint. You just have to warn them that it has the potential for lead-based paint.
And that's if it was built before 1978.
You just say, the property's built before 1978, and therefore it could have lead-based paint, and then you give them the opportunity to check for lead-based paint if they'd like to. That's it.
I have 10 days.
10 days to do it. 10 days to do that. And, you know, getting back to you don't have to tell them it has lead-based paint. On a test, be real careful anytime it says something like you have an absolute duty to disclose, or you must disclose all problems with a property. Is that the bar for us? Do we have an absolute duty to disclose? We have a duty to disclose what we reasonably can know about. We don't ever make guarantees that there are absolutely no problems with a property. That's not our job. Okay?
Always, never, those are all.
Yeah, be real careful of those kinds of words. Always, never, you know.
Except for civil rights.
Right, Civil Rights Act is one of those.
Which makes
No,
complete
right.
sense as we want.
That's it for the environmental chapter.
And you encapsulate.
You encapsulate lead-based paint. You can also remove it.
Paint over it?
So removal or encapsulation is the same process for lead-based paint or asbestos. Encapsulate it means just paint over it.
Do we need to know anything past encapsulate or removal?
About what?
How to remove asbestos? Do we need to know that?
How to remove asbestos? Carefully.
Daryl just said, put some asbestos over.
But no, you don't need to know how it's removed. You just need to know removal or encapsulation. Removal is a very expensive, messy process because truthfully, with either lead-based paint or asbestos, the problem is it becoming airborne, right? So the one thing you cannot allow it to do is become airborne. How do you keep any dust from becoming airborne?
Well, you gotta go in there with a fancy suit and seal off the house, like
Well,
put a tent around it.
that still lets it become airborne. How do you keep it from becoming? You wet it. And so the only way to remove all that stuff safely is essentially drown it as you tear it out. Imagine what kind of damage. Absolutely. It does tremendous damage to the property. That's why it's almost never removed and it's almost always encapsulated. Okay? Removing it is tremendously expensive.
They're keeping it from not being airborne.
Just as a protective mechanism for themselves, yeah.
Probably get airborne.
Yeah.
If you poured it fast enough, it could just
So,
shoot up.
yeah. So but it's really expensive to remove it. Really expensive. All right? We good on that?
That's my favorite chapter.
That's your favorite chapter?
Things to remember.
Well, how do you feel about the last chapter? Because that's where we are. The last one.
I know that.
And gosh, we've got to do it in 7 minutes. How about that?
No questions. Let's go.
Here's the good thing. It ain't going to take us 7 minutes.
Good.
Because this chapter's all what? Math. This chapter's all math. And what did I tell you about this math question when you see it on the test? Skip it and come back till the end. Do it last because it's going to take you the longest amount of time, right? Question. One. Singular. There's only one. That's it. You'll only have to do one of these. Now, that doesn't mean the math that's involved here is only isolated to one question, because could you get a separate, like, what's a tax proration, as a separate type question? Absolutely. But as far as one question that have you do all of this math, just one. Just one. And that's why I say, save it till the end, because it's going to take you a long time. And I would rather you invest that time in feeling confident you got plenty of time to do everything else, right? So just when you get to it, you'll recognize what question it is. Be like, look, I'm writing that number down. I'll come back to it last. I'll do that one last. Because what I don't want you to do, because the math's going to be sort of in the middle. It's not going to be all the way at the end. It's going to be sort of toward the middle of the test because it comes before the state section. So I don't want you to spend all this time doing this and then not have time to finish, to really read the other questions. So it is split into national and state. It's graded as one, but it's split into two separate sections. Okay?
So it's two separate tests?
No, it's one test. It's one test, but it's clearly labeled national section, state section. Yeah. Okay? So, in this chapter, other than the math, the only things we need to talk about are what sorts of things you are responsible for verifying on a closing statement. First of all, is it all things? No, we are not responsible for verifying all of the entries on anybody's closing statement because we can't. There are things on there that we can't verify. I can't verify the seller's loan payoff. It is what the bank says it is, right? I can't verify what the discount points are because they are what the bank says they are. But can I verify the property tax proration? Yes. Can I verify the excise taxes?
Yes.
What other things? Commissions. Yeah. I can't verify insurance. It is what the insurance company says it is. Earnest money, due diligence fee, purchase price maybe. Yeah. Those are the kinds of things we can verify. Pretty much anything that pertains to the loan, everything else we can. Homeowners dues, we can prorate those. We can verify those. Sure. Okay. Is everybody good with that? The kinds of things that we can verify?
What about just like not excise tax, but actual tax?
Property taxes? Yes, the property tax proration, that's absolutely one we can verify. Because we know what the property tax bill is, and we know how many days have passed. So we can always do that verification, right? Do that proration. Are you comfortable with that proration? With prorating the property taxes?
You can hit us
Seller
with it
takes
one
the
time.
day
More
of
than
close.
7 minutes. Hey,
As long as you know that, you got it right.
What, you want one?
Seller takes the closing day.
Okay.
That was the thing that got me. Seller takes the day, the seller takes the day.
Closing October 19th. Property taxes. Have not been paid. Taxes are $4,960 annually. What is the tax proration going to look like on that closing statement? All right.
$13.78 a day.
Okay.
January 1 to October 19th.
So if remember, I say always write down your two statements, right? Seller owes January 1 through when?
October 19th.
October 19th. Buyer owes
And then the buyer owes the 20th through the 30th of December.
October 20th through December 30th, right? Now, who is paying outside of closing? If the taxes have not been paid, who's going to pay them outside of closing? The buyer. If they have not been paid, the seller's gone, right? They sure as hell ain't paying them. Who's going to pay them? They. Stop. See, that's the problem. When you start doing all of that shit, because that's what that is. That's a bunch of shit right there. When you start doing all of that, that's where you get yourself confused. It is a simple, elementary level, simple question. Who's paying outside of closing? Buyer.
So who pays
Because the only other option is that they would have had to tell us that the seller has already done what? Paid. There's only two options. The seller's already paid or the buyer's going to pay. Those are the only two options. So which one is it? The buyer is going to pay, right? So if the buyer's going to pay outside of closing, who's got to pay at closing? The seller. Circle the seller. And I'm not trying to be hard on you, Michaela. I'm just trying to make it, because the more we think on these closing statements, the more wrong you get.
I ended up getting it right. I didn't have to say it outside of closing. So I
Right,
thought you
okay.
knew who pays.
Okay, I got you.
I understood.
Good, good. So we need to prorate the seller's part of the year, correct? That's who we circled. That's who we need to prorate. So we need to figure out number of days from January 1 through October 19th. And that is, what, 9 full months, right? January, February, March, April, May, June, July, August, September, right? 9 full months. So 9 times 30 is 270. Plus the 19 days in October, 289 days. Correct? Now we need to know what?
What is the price per day?
We need a daily rate. So we're going to take that 4,960, divide it by 360. How much per day? 13.
It's 1377,777.
So 78, 77, either one's fine. Okay? 1378 per day, right? Times 289 days. How much? 39.81 or $82. 39.81 and some change. Now that's the prorated amount. How is it going to be entered on the closing statement? Who are we debiting and who are we crediting? Seller owes, so debit, seller, credit, buyer. $3,981 or $82. That's how that's going to be entered on the closing statement.
Would it ask you both at the same time? Like, would it ask you now, like, seller, what does the seller owe, and then what will the buyer have to pay the rest of the year? Would it give you, like,
No,
seller owe?
because the amount the buyer's going to pay the rest of the year is $49.60. Because the buyer's going to pay the whole thing.
Even if they've been credited.
Right. That's why they're going to pay the whole thing, because they've been credited this amount of money up front. So they now owe the whole bill later in the year.
Oh, I thought that would already go to it, and they would just pay the remaining.
We're actually giving the buyer this amount of money. The buyer is putting this amount of money in their pocket.
Why can't they just pay for it, like, up front?
Well, I can't. Who pay for it up front?
Like, if that's being credited, why can't they just use that money at closing to go towards their taxes and pay the rest of it then?
Because you can't pay it in installments. They won't let you pay a portion of it. You got to pay the whole bill when you pay.
Yeah, like, that's why you have it escrowed in.
Right. So we're giving the buyer this amount of money, and then the buyer's going to pay the whole thing later in the year.
So, question says the property taxes have not been paid, you pick the seller owes.
That's right.
And then what will the question say for us to pick the buyer owes?
Seller has already paid the taxes.
That's it.
Mm-hmm. Okay?
And if the buyer owes, then it's buyer debit.
Debit buyer, credit seller. Debit buyer, credit seller. Okay? Now, a couple of other things in this chapter. What does RESPA stand for? RESPA. Real estate. What's the S?
Something Protection Act.
What is this class? Settlement. Real estate settlement. Getting there. What's the PA stand for? Nope, but Act is right. Procedures Act. Real Estate Settlement Procedures Act. It's on page 573. The Real Estate Settlement Procedures Act. RESPA is the reason we have a closing statement. It's the reason we have to follow these rules, because the rules come from RESPA. RESPA is the law that governs all of this stuff. Forces us to do a closing statement.
Governs closing?
Yep.
Is that okay?
When what is involved in the transaction?
Real estate agent.
Nope. Loan. When a loan is involved in the transaction. When it's a cash transaction, guess what laws are in play? None.
Give me your money.
That's right. But when a loan's involved, you got to follow RESPA. So the two things that RESPA requires that you need to be aware of. Within 3 days after I apply for the loan, I have to get what? An estimate. We don't call it a good faith estimate anymore. We call it a loan estimate. It used to be called a good faith estimate. A loan estimate. What is a loan estimate? What does it estimate? My closing costs, my charges, what my payment's going to be, all those things. And then within 3 days before I close, I get what? A closing disclosure statement. So I can do what with the two things? Compare them. I get an estimate when I apply for the loan, and then when I get to closing, I get what? A closing statement, so that I can do what with that closing statement? Compare it back to the estimate. Isn't that what an estimate's for? Right? You get an estimate. Please don't read harder than that into this. Please don't. I'm begging you. Why do you get an estimate?
So you know how much you're going to be paying.
Woo! Listen to what she said, y'all. She said you get an estimate so you know how much you're going to be what? Paying. And then you get a final bill and you see how much you got to write the check for, how much you got to pay, right? And gosh, if you got an estimate and then you got a bill, isn't it natural to look and say, well, you estimated this and then you charged me this. That's the whole thing right there. That's all you need to know about it.
So that's just what that act requires.
That's what RESPA requires. It requires you within 3 days after you apply for the loan to get a what? An estimate. And then 3 days before closing to get a disclosure saying this is what the charges actually were. This is what we estimated they would be, and this is what they actually were. That's it. That's any time a loan's involved. We don't provide the estimate. Who would provide the estimate? The lender. That's right. The lender.
But the real estate agent needs to see the estimate too. Or no.
Well, you know, it's really touch and go whether we see these things or not anymore. We used to be much more involved, but they've gotten a lot more persnickety about protecting clients' information now. And privacy, and so sometimes we see them, sometimes we don't. I usually ask my clients for it so I can go over it with them.
But they don't have to.
They do not have to give it to us.
But it's beneficial.
It is, very. Okay? And that's it. I now pronounce you reviewed.